In this example, we are looking at the bond issue on and between interest dates. So we have a company that is authorized to issue $1.8 million in bonds on June 1st. They carry a face interest rate of 9%, which is to be paid on June 1st and December 1st. So we're going to prepare a journal entries to record the issue of the bonds under two different circumstances. So the first circumstance, A, says that the bonds are issued on September 1st. So up to this point, everything has always worked out perfectly mathematically. The bonds were issued on June 1st, and then they paid interest 6 months later, and so on and so on. But what's happening here is the bonds are available to be issued on June 1st, which means the next interest payment is December 1st, and then the following June 1st. But somebody is buying, or we are selling the bonds on September 1st, which is right in the middle of an interest period. So we have to take into account what happens. Okay? So in this situation, the person buying the bonds are required to pay any accrued interest up front. So from June, we have June, July, and August, which is all the way up to September 1st, is 3 months. So we calculate the 3 months of accrued interest. The $1.8 million times the 9% rate times 3 out of 12, because there's 3 months, gives us $40,500 in accrued interest. So what's going to happen is during this issue, or during the sale of the bonds, we're still only going to have bonds payable at the face amount, but we're going to credit our bond interest expense for $40,500 and then debit or collect cash of the sum of those. So when you watch example 15B, it'll make more sense of what happens after this. So at this point, you want to keep in mind that anybody buying bonds has to pay any accrued interest up front, and this occurs when the bonds are sold between the issue day and the interest payment dates. Now B just says the bonds are issued on June 1st. So on June 1st is the actual issue date. So there's no accrued interest. It's working out perfectly. So we calculate the amount of cash received is the 1.05% of the 1.8 million. Bonds payable still 1.8 million. And then we have an unamortized bond premium, because we issued it above 100 at $90,000.